The single biggest penalty in the tax code is not for cheating. It is for forgetting. Miss one required withdrawal from your retirement account after age 73, and the IRS can take 25% of that money as a fine. In the next 3 minutes, who has to withdraw? How much? The 2 deadlines, and the trap that catches even careful retirees. Here is the rule on one screen. So what is an RMD? It stands for Required Minimum Distribution. All those years, your traditional IRA and 401k grew tax deferred. Starting at 73, the government wants its taxes, so it forces you to withdraw a minimum amount every year and pay income tax on it. Skip the withdrawal, and the penalty is 25% of whatever you failed to take out. Which accounts does this hit? Traditional IRAs, traditional 401ks, and most workplace plans. But here is good news many people missed. Roth accounts are exempt. Roth IRAs always were. And under the new rules, Roth 401ks no longer require withdrawals during your lifetime either. Check your accounts against this list. And how much must come out? A simple division. You take your account balance from December 31st of last year and divide it by a life expectancy factor from the IRS table. At 73, that factor is about 26.5. So a $500,000 IRA means withdrawing roughly $18,900 that year. Your brokerage can calculate the exact number for you. In fact, most will do it automatically if you ask. Now, the trap that catches careful people. Your very first RMD has a special option. You may delay it until April 1st of the following year. Sounds generous, but if you use that delay, you owe 2 withdrawals in the same year, and both stack onto your taxable income at once. That can push you into a higher bracket, and even make more of your Social Security taxable. Sometimes the delay helps, but for many, taking the first one on time is the smarter move. Here are the traps side by side. Now the smart moves. First, automate it. Every major brokerage can calculate and send your RMD on a schedule. Set once, never miss again. Second, if you give to your church or a charity anyway, ask about a qualified charitable distribution. The money goes straight from your IRA to the charity. It counts toward your RMD, and it never touches your taxable income. And third, if you already missed one, act fast. Corrected within 2 years, the penalty drops from 25 to 10%, and the IRS can even waive it entirely if you file the right form with a reasonable explanation. Let us recap the numbers that matter. So, to sum it up, from age 73, the IRS forces a minimum withdrawal from your traditional retirement accounts every year, about 4% at first, due December 31st. Miss it, and the fine is 25%, the biggest in the tax code. Roth accounts are exempt. Charity giving can satisfy it tax-free, and the first year April delay is usually a trap. So here is your one action step. Call your brokerage this week and ask one question. Is my RMD calculated and automated? That 5-minute call permanently removes the biggest penalty the IRS has. This is general information, not tax advice. So confirm your own situation at IRS.gov or with a professional. If this helped you, subscribe to the Daily Brief, where we explain the news and your money in plain English every single day.